Well, hello and good evening and welcome. I am honored to be here. If you don't know me, I'm Diane Swonk. I've been around here a long time, and I now get to be on the board of the Council of Global Affairs, which is an incredible honor. I am just thrilled to be here tonight. The Council of Global Affairs here in Chicago, we're really working on trying to understand what's going on in our global economy. And yeah, that's kind of like my life these days. But I am honored to have two people who are very much on top of it. And that is Joyce Chang is the chair of global research for JP Morgan Corporate Investment Bank. She's got over 30 years in finance. I think I probably even beat you. She's been named one of the top most powerful women in finance by American Banker and included in Barron's 100 most influential women in finance lists. And then we have Phil Levy, who I've known from my time at the council, but he's lead trade economist at the World Bank right now. And he's done in-depth research on supply chains, consumption, and trade, some things that kind of matter a lot right now. He was the senior economist for trade, the only economist for trade for the President's Council of Economic Advisors and the policy planning staff the policy planning staff for Secretary of State Condoleezza Rice. I met Phil, like I said, my time here with the Council on Global Affairs, usually I was on the other side, not having to moderate, was answering the questions. Now Phil's going to help me if I get off on the moderating part, and it's just an honor to be with both of you. So I thought we're going to start today's fireside, after which we'll have time for Q&A. So we're going to go for about 45 minutes. And then please hold your questions till the end, although you will be able to, if you're online, you're going to be able to submit your questions online at ccga.live, Live. And before we begin, I'd like to remind everyone that today's program is on the record, not off the record, and any views expressed by the speakers here, including myself, do not necessarily reflect those of the Council on Global Affairs. So with that, I'm going to start out with, I think we had kind of an interesting couple of 24 hours already. There was a 100% tariff on the movie industry, and then it was walked back a bit. And it kind of illustrates where I think the elephant in the room is, and that is that the economic policy uncertainty, we actually as economists measure this kind of stuff. Globally, it's lapsed and eclipsed the pandemic. In the United States, it's now done the same, and is even higher than during the pandemic. And it acts, in our view, and in the research, it acts as its own tax on the economy and is showing up in a lack of earnings guidance, which I know you're having to do with Joyce. And the Treasury Secretary once used the term recently, strategic uncertainty, which can be used at times in negotiations, although it's a little harder when you're using game theory in the context of trade negotiations. So I'm going to start with the both of you. Joyce, why don't I start with you in terms of, do you see the uncertainty that we're in right now abating anytime soon? And then I'll give Phil a chance to either agree or disagree and add color.
Well, Diane, it's great to be with you and Phil, and wonderful to be at the Chicago Council. So I don't think the uncertainty is likely to abate, because I really do think we are in a period of regime change. And it's multi-domain regime change. It's not just about economic relations. It's about security issues. It's about strategic alliances. And I think very much, as you said, Diane, that since this is a much more mercantilistic approach, the desire isn't necessarily to remove that uncertainty. So when we've had questions asked about when are we going to get more coherence and clarity on the policy, often the answer that we have received is, well, that's not the best negotiating strategy. So I think this is regime change, which will play out on, a number of dimensions. And some call it greater regionalization, some call it fragmentation. But we are seeing a shift in trading and investment patterns. We're seeing a shift also in, security issues and the alliances that are going on. And we're seeing a lot of talk where, yet we have yet to see sort of the key players really come to the table and talk about this.
That's not exactly reassuring, but I agree. Phil, do you have anything more reassuring on the uncertainty front?
No. But first, I'm going to also, now that I got the mic for a second, wonderful to be back here with everyone. I'm not going to try to repeat what Joyce said, because I think she had this right. I will say you can look, some of the institutions, and this may be what you meant by regime change, some of the institutions that we had built up over decades were exactly intended to limit uncertainty. If you look in the trade field, things like the World Trade Organization, the successor to the GATT, it was because people needed to make plans, they needed to do investment. And frequently what you would see when you'd have an agreement, like the Uruguay round in the 90s, some outcome from the Doha talks in the last decade, you would see something where over the next 5-10 years, we will do this, and you'd have very gradual implementation. And globally, if, say, a developing country wanted to know what they were facing, they could look and see, that's it. There's MFN, most favored nation, or normal trading relations status. It's all very clear. It's agreed. It's, they have it written up in Geneva. That's what it'll be. And those are the institutions that we have not seen, that we've seen a lot of countries turn away from, or seen a number of countries turn away from and do other things. The thing I would note, if I can add a little something maybe, is when we talk about uncertainty, it's important to keep in mind why this is so important. And I think, and so what I would emphasize is the time frame that we're talking about. So uncertainty, if I'm meeting a friend later for dinner, if I don't know where we're going, it doesn't matter, because at the last second, fine, I'll accommodate this place or that place, who cares? The businesses that we're talking about have much longer time frames. If they're thinking about the investments they're doing, if they're thinking about the orders they have to place, these are months or years that they have to go in advance. And so the impact of that uncertainty is closely related to just how much do you need to pre-commit. And then the behavior that we get from this is, what does a business do when you don't have certainty, when it's all sort of up in the air? Here, Joyce will probably be able to give more detailed answers, but I would say as a general rule, we see a lot of them freezing up. You wait, you hope that things resolve. And then what we've seen in the past, if you have persistent uncertainty, if you think about, for example, a business investing in a country that has conflict, for example, what you see is you invest less. You have a very high threshold that is going to take a very high rate of return to get you to overcome that uncertainty. And that's economically problematic.
Yeah, and I often liken it to the broken stoplight at a busy intersection. Everything backs up, and some people opt out entirely and do a U-turn and wait for the traffic to clear or the stoplight to be fixed. And that's kind of what we're seeing among our own clients right now, is some sort of paralysis and freezing up, which inactivity is the enemy of an economy that you want to move forward. So, which brings me to my next question that I want to throw at you guys, and that is risk of recession have escalated. The poly market has recession. I looked it up today. It's a little below 60%. Our own forecast has a 60% probability. We're just assigning probabilities because the world is so uncertain now. That's all we can do. And even those are a bit of a guess, but you're not supposed to know that. But it is, before we dive into the outlook, and I'm going to start with you, Joyce, we have our own effective tariff rate. Phil and I were talking about how hard it is to calculate these tariff rates, and they're a moving target. Our own is still north of 20% with recent changes and some things that are coming down the pike that we know are coming. But they could change, and there's trade diversion. There's some things that aren't substitutable. When you've got 145% tariff on one country, there's some things that won't come in at all, and the shipping has stopped in many ways from China. So, that compares to a little below 3% at the beginning of the year. So let's level set. Where do you think we are after the recent changes, Joyce? And you were just at the IMF meetings along with you, Phil. But why don't you give us a level set of where we are after we had the April 2nd announcements, then we had some changes. We could have another announcement by tonight, but where are we now? Where do you think we are in terms of the environment?
Well, Diane, I think we're very similar in our views because we also have recession risks at 60%.
It's really bad when we all agree because usually economists don't do this.
but so, tariffs at 2.5% to 3% at the end of Biden's term. Right now, it's at around, we think 23%, but we think it's going to settle at 16%. So what are we assuming on the tariffs? We're assuming that the 10% universal tariff stays in place, that you're going to have some of the product-specific tariffs that are around 25% stay in place, and that the China tariff will still be higher than the rest of the world. It won't be effectively what it is right now as an embargo. I mean, at 125, 145%, you've halted all trade. But we had been assuming a 60% tariff for China even back in November. We thought that China would always be treated differently. So what does that mean off of GDP growth or inflation, how we're looking at the fiscal deficit? Well, U.S. grew 2.8% last year. We have growth coming down to 1% and going into recession by the end of the year. So that's a pretty big move down. Like if you look at Europe grew 0.9% last year. It will grow 0.9% this year, even with the tariffs, because they've done so much fiscal stimulus. So a mild recession, not a financial crisis, more of a traditional recession. If you look at the inflation impact, well, there's really two effects that we take a look at. First, you've had this big drop in oil prices, but the tariffs are a tax. It's actually the biggest tax hike that we've seen since 1968. I mean, a 2.5% of GDP tax hike. So we do think that the inflation pass-through, it's not 1-to-1, but it's probably about 0.8. So we have a 1 to 1.5% increase in PCE inflation, in the forecast, and we have the fiscal deficit remaining elevated. The DOGE, all of this. I mean, we're not going to see that much in fiscal debt reduction. And if you don't sunset the tax cuts, we see a fiscal deficit that stays at 7% of GDP next year. So a more stagflationary environment, a mild recession. Now, it's not necessarily imminent. We don't have the Fed doing anything until September. And even then, I think it really will be dependent on some of the data that comes out. Do we see breaks in the labor market? It could be more on the labor market dynamics than on the inflation dynamics as far as what the Fed does. But this isn't about monetary policy. So there's only so much that the Fed can do that will really make a difference here.
And Phil, well, I actually want to follow up a minute. You were at the IMF meetings as well, and you had some interesting results from the investor and how investors are thinking about this environment. And I know your background there. And why don't you share some of that? Because I was really fascinated by that.
I think that the one thing that's very clear is that there's a feeling that term premium is going to stay high here.
That's the extra amount you have to pay on. I'm always translating the extra amount. I have to talk to a lot of accountants. So that's the extra amount you have to pay in the Treasury bond market. So
in the Treasury bond market. So in the Treasury bond market, we have $9.3 trillion to roll over in the next year. And 30% of that's held by foreigners. And 30% of that has less than a 2-year maturity as well. So, I mean, the U.S. needs friends. If we're going to choose a moment where we're going to be more confrontational, we're also doing it at a point where the deficit is very high. So we ask a bunch of questions in our investor survey, and we had about 500 responses, but we had about 1,000 people at this program. I'd say that a good 65% of them were from the U.S., but an international group, the rest, many of them from Europe, from other parts of the world. So we asked, what asset class should you own this year that you think will outperform? And oftentimes there's real consensus in these surveys. It had been U.S. equities, bar none, for the last couple of years. So this year, not only did you not get that any asset class got much conviction, the highest asset class was 25% think that this will be the best performer. And what asset class did you think it was? It was U.S. Treasuries. And then 57% thought the asset class that would have the largest outflows would be U.S. equities, even with the correction that we've seen year to date. So very low trust, very low conviction was the way I would characterize the investor mood.
And trust is the oil of a market economy. Without it, the engine seizes. Phil, I'm going to turn to you because you've done a lot of work on supply chain. So I'm going to start with that. And the fragilities obviously became very clear during the pandemic on supply chains. How should we be thinking about disruptions to supply chains in response to the tariffs that we have so far?
Yeah. Well, thank you. I think we did see some fragility. I'm a little bit of a contrarian on this. I think that in the pandemic, supply chains performed really well. By which I mean, if you go through almost any measure of, was it imports, was it the amount Americans consumed, it all went up. But there's one of the things we saw from that was it went up, but there's only so much adjustment you can make. And so when we were hit with a very high demand surge, it felt like, well, yeah, but they're not delivering everything I want. Well, that's right. They can't, because you just can't adjust that fast. And I think that's part of the lesson we take for the current setup is, one of the ways we've been able to have goods at a quality that we get and at a price point that we get is because we have these fairly intricate supply chains. That people don't set these things up because life is easier when you're on odd hours calls to Asia, trying to manage this stuff. You do this because that sort of specialization, that bit where somebody can produce something, that you get specialization in equipment, specialization in skills, and it brings costs down. And you all may have seen it. If you haven't, I urge you to go look for it. Things like the iPhone or a Boeing passenger jet and where these things are made. And you'll get somebody who makes wingtips, and you'll get somebody who makes the back edge of a wing, because these are specialized skills, specialized materials. And one of the things that means is it's very hard to switch around. That it's not something where you can just say, well, fine, I'll just make it all here. That the thing that often gets lost in the conversation is that these are often very expensive. And that the way it all works and the way we're able to get stuff at relatively low prices is you operate at a large scale. And so you will have somebody where I specialize in wingtips. It's not that nobody else could figure out how to make a wingtip or a semiconductor chip. It's that I'd better run this thing and make an awful lot of these if I'm going to be able to spread the cost of that equipment and the investment over enough that the prices are low. And so the couple lessons you get out of that for the current situation are, one, it takes a lot to set that up and it doesn't shift very easily. And if we did shift away from it, we have to start worrying about what things cost.
Well, I think most people, one of the things that we find with a lot of our clients right now, and our logistics and our trade and customs group is quite busy right now, is that it strikes me as how few of our producers actually understand their supply chains are longer now than they were pre-pandemic in Europe and in the US. It's not the case in Asia, where supply chains have gotten shorter, but they're actually longer. And part of that's because people were avoiding tariffs and using a connector country or moving their supply chains a bit since the last trade war. And it was carried on by the administration that followed. So on that point of thinking about how complex our supply chains are and the desire for the administration's focus on manufacturing jobs and bringing manufacturing back, I know you've done work on that as well. Provide some perspective on how that could work. I let a bit of my economics bias show up how that could possibly work in the time frame with uncertainty as well. But give us some perspective on that.
Well, I appreciate the invitation to perspective. So let me take you back about 6 decades or so, 5 or 6 decades. And if you looked at the way the labor force in this country was deployed, roughly 1/3 of the labor force, the civilian labor force, was in manufacturing. And
where I grew up, Detroit.
Yeah, there you go. And there's another
I'm old
part.
enough to remember it too.
That's right. The whole downturn thing started right around when I was born. I don't think it's causal, but actually, what we saw was
I became an economist because I grew up in that environment.
Okay, that's reshaping. What we saw was that 1/3, by the time you got to the early 2000s, this is more like 8 or 10%. But that share, the drop of that share, is fairly steady all the way through from the 60s on down. And so the big momentous trade events that were supposed to shape things, whether it was the Uruguay round, it was NAFTA, it was China, joining the WTO, those things aren't really a blip at the end in terms of what we've seen with this trend. I would also note that it's when we sort of say, what happened to American manufacturing? It really depends how you measure. That if you measure by that metric, whether it's what share of the labor force is involved, you see this big decline. And that's often what you hear in the political discourse. Mm-hmm. If you instead say, let's look at output controlled for inflation, so real output, Actually, it hasn't done that bad. It actually grew fairly steadily. More recently, a dip. It tends to go down with recessions, and it's had a hard time recovering from the global financial crisis. But actually, impressive growth in a lot of this. So how does one reconcile this? How do you have growth in manufacturing output, but a smaller and smaller share? You get big productivity gains.
Right.
You get automation. And one of the things this has meant, I think one of the reasons why people are lamenting the passing of the old approach to manufacturing so much is even that 8 or 10% that's left, these are not the same kind of jobs that you had in the 50s and the 60s, where somebody who was a hard worker, maybe didn't have a lot of education, but they put in a good solid day's work and they wanted a path to a middle-class lifestyle. That's often not what's required now. You need more than that. You might need an associate's degree. You might need to be able to reprogram that computer-guided machine tool. And so that change is felt very acutely. Unfortunately, what that also means is this is not an easy thing to undo. That if it was in fact automation that changed this, and there's a lot of evidence that it was, it's hard to see how blocking trade therefore gets you back to where you were.
And you talk about the workers and who would do this. If we're changing our investment regime change on investments in education, which it looks like we're cutting education at a lot of levels at the moment, and we're also curbing immigration, how do we get the workers we need to work in these plants?
Yeah, it's a question of how these things add up. We are currently at 4.2% unemployment. That's historically a very low number. I mean, this was usually around the number where the Fed would start worrying and thinking, I don't know, maybe this is going to start causing some inflation acceleration. We have to see. So that it means there's not a lot of excess in there. And you're right, as one changes labor market policies that tighten things further, that even more so. So even if you did have manufacturers who are inclined to go do very labor-intensive techniques, you would potentially be getting a squeeze there, and then you would have to think hard about what you thought the Fed was going to do the next time if you started seeing unemployment dropping down to 3.5 or 3.3.
Yeah, it makes it much harder for the Fed. And this one's now on interest rates for you, Joyce, because I know you've thought about this a lot, and we see a bout of stagflation as well, and that makes it very difficult in our forecast for the Fed to be cutting rates as rapidly as they had hoped. And the soft landing seems to be a moving target as well, given both of our probabilities for recession. That's a much harder thing to do. In terms of, the interest rates more broadly and the bond market's reaction, we actually saw the dollar depreciate and interest rates go up all of a sudden after April 2nd. And that was a very unexpected thing because usually every other time we've seen a spike in uncertainty in the world, everyone flooded into the U.S. Treasury bond market and the dollar actually appreciated. And a depreciating dollar actually has a lot of issues with it. It causes imports to be cheaper, imports to be more expensive, which then adds to the stagflationary it could be a secondary wave of inflation for the Fed to deal with. What is your view in terms of where interest rates are, the bond market? You mentioned, the term premia. De-dollarization is a word people are using. What about the dollar reserve currency status? Are we going to lose it? I know you've got several scenarios on that. Why don't you give us some insight in terms of your views on that?
Yeah, no, it's sort of the question du jour, but I have to first of all just agree with Phil. If you think about manufacturing jobs as 8% of jobs, and that half of that is sort of marketing, it's not even the actual manufacturing, it's 4% of jobs. What are we doing this all for? If technology really was why we have gotten the higher output, then how does this actually solve the problem? So the first thing I would say is that there's a very different way in which U.S. investors are looking at the dollar and U.S. treasuries as safe havens versus international investors. And international investors are 30% of the holders. So U.S. investors are asking right now, after 100 days, have we hit peak uncertainty and peak Trump policies, meaning that now we're seeing that DOGE is being talked about less. That the Fed independence now, that's not a challenge as much. There's more room to de-escalate on the tariffs. So many of the questions that I get from U.S. investors are we at a point where we've kind of seen the peak of the worst of this and we're going to go back to some type of normalcy? Now, the questions from international investors are completely different. They're asking questions that I really haven't been asked before. They're asking, if you're a reserve manager, a sovereign wealth fund, a pension fund, will I be able to get my money out of the United States? They are asking questions like, will there be a withholding tax put on holding treasuries? They're asking questions that some of them I can't even answer, that at the state level, will Florida restrict Chinese from owning property? Is that going to occur in Texas? Are there going to be restrictions on holding Chinese investments? And so the difference is that internationally, the U.S. dollar dominance and the safe haven status is going through a rethink at a point where our fiscal deficit remains, elevated in a record way. And so the U.S. does need friends. So if you're going to change the order which you yourself created, and the U.S. in many ways was very lucky. It's 4% of the world's population, 25% of GDP, but it had sort of set the world order and had run it. So now you have this uncertainty that is coming out about the safe haven U.S. Treasury status. Not that this moves quickly and the dollar dominance, but I think it's very important to point out that this is a new set of questions. So if the tariffs were, everybody, economists said it would lead to dollar strength. Why have we had the dollar weakening? So we have U.S. growth going from 2.8 to 1%, Europe at 1%. So that growth differential, what you're seeing is that the uncertainty on the sort of flows, repatriation of capital, that if you had invested in U.S. equities, you've had outflows, repatriation of capital back, all of that is outweighing the tariff. So you've had the dollar weakness. And last week in Asian FX markets, you had a level of volatility, like for the Taiwan dollar that was, 6% volatility, which is what you usually see in 1 year, not in 1 day. And so you're seeing that in particularly with many of the Asian countries, which have been large buyers of U.S. treasuries, and large holders, more questions. So if you take a look at a country like Japan, for example, there's been a lot of questions on when they reach trade agreement. They own 1.1 trillion of U.S. treasuries. It's the equivalent of nearly a quarter of Japanese GDP. It's 12% of the treasury holdings. So I think that trying to sort of disconnect the world and decouple the U.S. from the rest of the world, it's simply not possible when you look at how interconnected we are. So I think there have been questions, about the safe haven status for treasuries, about just the direction of the dollar, because you've seen some big moves. It had been on euro bearishness at first, but now it's kind of moved more broadly. But just if you're international, do you just not feel comfortable holding as much in dollars, and would you rather be diversified? And this is one reason why you see gold continuing to go up. And we think gold could hit 4,000 by the second quarter of next year. We don't think that rise is completely, over. So what does this all mean for, bond yields? So the term premium, your sort of, the excess charge, we think, if you're a corporate, you should be really using for long-term planning, not necessarily what will happen over the next 3 months, probably 4.5% for treasury yields. And taking into account that it's the fourth year, we're not at inflation target, so 2.5% to 3% inflation, a 1% term premium, 1% real yield, around 4.5%. So this period where you had the great moderation and zero yields was more the exceptional period. We're now going back to something that is going to return to levels that existed prior to the great moderation. It's just that I see, and probably Diane feels the same way. There are many people we work with who just don't even have any record of working during that period, right? So it's not just that we have the regime change and the fragmentation that's going on. We also have more questions that are being raised about market function. You've gone more electronic in this market as well, just as you had technology change manufacturing. So the market depth, I mean, which is the amount that you can actually trade, is more imperiled right now as well.
There's a lot going on there, and I agree 100%. So, Phil, as we're talking about all these, here we are looking at the U.S., we're looking at mostly us. Joyce is talking about how, our friends are a little bit leery about us right now. What do you see as the fallout for developing versus developed economies as we're moving forward in this environment? Because it really is a very different kind of environment. And, we saw such extraordinary growth among many emerging markets for a while. China has clearly lost some of its momentum prior to what happened since January 20th. But I think, these are important issues, is that, what is happening? Is there a break? Are there changing alliances? What are you seeing in terms of developing versus developed economies?
Yeah, it's a good question. It's a hard question. One of the reasons is because normally we would say, well, we'll analyze this. And I know this is what you both get caught up in. Okay, well, let's first characterize the shock. What is the shock? And as you were describing earlier, that changes at irregular intervals.
Yeah.
I think, one of the things we've been looking at the bank is sort of trying to think of this as a new environment where you have not so much necessarily a world breaking up into trade blocks, but sort of a fragmentation of the policy-making process, which is, one of the things that goes with it is you can sometimes have incompatible policies, but you also get much more frequent generation of policies. So that's the kind of thing we're looking at. When we have done analyses, internal analyses of sort of who wins and who loses, it depends heavily on the scenario. That it's sort of, you've had various things, who was targeted. You can have, our North American neighbors swing from being way on the good side to being way on the bad side, which also then goes to show you that it's not really whether you're developed or developing, but how big a trading partner you are, and what kind of a shock you're facing. And actually, even among developing countries, clearly, when you're seeing a challenge to institutions like the World Trade Organization, which was trying to provide certainty, which was trying to provide a path to prosperity. And we've seen some amazing stories of developing countries use trade as a way to sort of move up into the ranks of developed countries. I mean, you look at a country like South Korea, for example, which in the 1950s was poorer than India. And then with trade as a principal reason, lots of argument about how you rank all the reasons, but as one major reason, they've moved on up. If that path, that avenue is getting shut off, that's a very serious thing. You do also see, though, as you've noted, for some countries, it's an opportunity. A neighbor gets blocked and people come and at least give you a look as a supply chain source who might not have looked under a different regime. So there are winners and losers, but it shifts as the scenarios shift.
It's kind of interesting. I think of Vietnam, and in one way, it was a winner from the last trade war, and it got caught in the crosshairs on April 2nd. It's negotiating now, but it could still be a winner now, which is kind of an odd outcome.
The connector countries that you mentioned before.
The connector countries, yes, exactly. So except for Canada and China, we've not seen much retaliation. Between the two of you, what's the next shoe to drop, do you think?
Well, I think that first you have the deadlines. You have the 90-day pause, 90 deals in
July
90
9th.
days, which we haven't seen yet. And even though India seems like it has something in the works, Argentina, I mean, our biggest trading partners, China, Mexico, Canada, Europe, nothing's even started. So I think you're going to get to that 90 days, and then they're going to say, like, it's another 90 days if you've started working with us, in negotiations. It's not clear. I mean, the real thing is, when is U.S.-China going to begin? Because I think there's really been no discussion there. And, at a tariff of 125 to 145%, that's essentially a trade embargo. And that's where I think you will see a lot of the effects that Phil talked about, that, for small businesses, they simply don't have the working capital. So you will begin to see that in the first quarter this year, there's been a tremendous amount of front loading anticipation of the tariffs. So you have this disconnect on sentiment is very weak, but the hard data is quite strong. You're going to have by the middle quarters of the year that more of that weakness, the recession risk shows through, and also some of the inflationary pressures as well. But the next shoe to drop will be that you get to the 90 days and you're getting closer to the recession risk, and you need another 90 days, and if the U.S. and China are not talking to each other, but then you have budget reconciliation with a July 4th deadline, and that's where you're going to have much more attention on the fiscal deficit. And with the fiscal numbers that we're looking at right now, they're talking about some things that are incredibly unpopular that will have to be discussed, like Medicaid, raising taxes for wealthier. Things that Trump had said he wouldn't, during his campaign, he wouldn't touch, that will have to be discussed, because the gap they need to fill is $1.5 trillion, and they've only filled about $4 billion of that. So I think the next shoes will actually be to turn from the tariffs to the budget reconciliation, and then after the 90 days, what have we really accomplished with the major trading partners? China, Canada, Mexico, and Europe.
I would say, you're right. We have to sort of see what happens with retaliation. I think probably what a lot of countries are considering is there's the negotiation, what's going to give me, an edge in making my interlocutor do what I want them to do. There's also, of course, that for a lot of countries, does this hurt them more than it hurts me? That you put these things on and it can be painful. There's another consideration, which if it's not up there, it ought to be, which is what does it mean for the broader trading system? And so whether it's sort of retaliation or whether it is actually accommodation of the sort, one of the big underlying principles of the global trading system is this most favored nation status, which says you're going to treat every other fellow WTO member as well as the most favored nation gets treated. That gets tricky. When you start, now, there's some things you could do that are exceptions with retaliation and sort of an unwinding of a deal. Usually you did that through a dispute process. The dispute process is not functioning very well at the moment. But certainly if you make concessions. So that's a real concern, I think. And that's what I'm watching closely, is to see what will happen.
This brings up another issue, and this is the sort of, the administration seems to believe that tariffs are a means to multiple ends that sometimes, to me, seem conflicting. Are they a negotiating tool? Are they a revenue raiser to offset some, not many, of those tax cuts that they'd like to extend and expand? Are they to eliminate trade deficits entirely because they see trade deficits as a weakness of ours? Or are they to onshore? Which one of those, and each one of you can take a stab, do you think is the number one issue, or do you not think there is a number one issue? And what's the other side of that? If you're trying to negotiate with the administration, how do you play against that?
I'm going to punt on trying to interpret which was the primary motivation of the Trump administration. But I will say, but you raise a very good point, which is, if you get, as Joyce said, you have sufficiently high tariffs, you block trade, there's no revenue there.
No.
And not only that, is there no revenue there, but if you've done this and it stays that way, nor is there any leverage on sort of making the other country do something. So similarly, if you take those tariffs way down so that you are now raising a lot of revenue, now you're not providing the protection of the sort that you had thought. So the tension is real. I actually, aside from trying to be diplomatic and save my job, I think we honestly don't know, and we have to watch and see.
Well, I think that and I think it's a great question, Diane, because they've outlined so many contradictory goals. So, we want a weaker dollar, but we want tariffs, which is typically at odds. We want lower inflation, but the tariffs are inflationary because they are a tax. So the goals that they have outlined and the tariffs, don't serve that purpose. But I think the tariffs are, used for, a number of things that are not economic. They're used for geopolitical leverage as well. So, like, oh, well, if you don't deal with fentanyl and immigration, then, tariffs are put into place. And I think part of the problem also with the tariff proposals, if you're saying there's a baseline that's universal, you haven't differentiated with who's an ally. So now, the whole post-World War II system was sort of built on this, we have a set of allies and no one knows where they stand if it's back to just sort of a bilateral arrangement that needs to be negotiated in a very mercantilistic way. So I think the tariffs serve, many purposes. It includes revenue, but also the goal was weaker dollar, lower inflation, and also these geopolitical goals related to border security, as well.
So I'm going to have you guys do one last sort of before we turn to Q&A, and I've got some questions here, which are already coming in, and there also is going to be some microphone ones. But what do you think, before we turn to the questions, what's the largest upside and downside risks right now you see to the outlook for the global economy and for the U.S.?
No, so the upside risk is that, a lot of this is self-inflicted and that you course correct, and you do that in time where you limit the amount of damage that's done. And that is, I think, if you wanted to take the optimistic view or more of a U.S. view than an international view, is that, this is not like COVID where you can't plan for it. This is something where you could change your mind and you could course correct. And I think, one example of that is, many of the meetings we had in Washington, D.C. around the IMF, everyone said, well, look, the U.S. is going to walk away from Ukraine. But then, you had the Pope pass away, which was not expected. You had the 15-minute meeting, which we all saw the picture of that. And they agreed on the mineral agreement, which means that the U.S. can't walk away. Even though it's not a ceasefire, the U.S. is in the game. So you can look at the positive scenario as being that, you can course correct and change direction because it's up to a leader to take
can change with
that.
the stroke of the pen.
And that's why I give the example of Ukraine. Now, what's the worst case scenario of this is that you have real supply side damage, that really is structural in nature. It's not transitory in nature. And that you also have this rise in geopolitical tensions, that accompanies it, which means that your sort of risk of conflict is also much higher at the same time. So, and that much of that probably does center back to how do they deal with the U.S.-China relationship.
Bill?
I very much like the way that Joyce described the upside, so I'm just going to go along with that. So I'll give you three things that I worry about as downsides. I'll do it briefly. One, animal spirits. That, there's a lot of in macroeconomics, I don't count myself as a macroeconomist, but there's, what if everybody decides all at once that this is a good time to pull back? Ooh, and if they all do, then it's self-fulfilling because it was a good time to pull back. Because we're playing with some of those things now, where you get these sort of coordinated. But usually we try to do exactly the opposite of what we've done recently, which is you want to sort of smooth consumption, smooth investment. And so we've front-loaded things. You can
we pulled a lot of forward.
Right. So the worry that you're going to get animal spirits that sort of send things awry, that you'll have people with high expectations of inflation, these things which are not necessarily what we work through our models, but they come in and they play a big effect. That's one thing. Second thing, I worry a little bit about the chance of financial crises or something breaking. I say this in part because I get to use my favorite Warren Buffett quote, which is that it's only when the tide goes out that you find out who's been skinny dipping. You get these sort of big swings and big movements, and then maybe who had a leveraged position, and it turns out, ooh, that was fragile, more fragile than we knew. Not that I know anything about any of this, but we have in the past seen such things. And then my final thing would be alluding to what I talked about sort of earlier, things that fracture the system and that make the system hard to put back together again. If we move away from MFN, if we start seeing some of the important institutions not function as well, that it took a long time to put that stuff together, and it'd be hard to repair.
No, and I very much agree with Phil. The animal dispirits and the negative feedback loop can make this very self-fulfilling. And we've seen that in some of the market moves that we've seen, recently. But, on, the financial market stability, I mean, look, when you tend to see a crisis occur, it tends to be in the newer products. So we get a lot of questions like, what do you think about crypto? Like 2 trillion has gone. And what do you think about private credit? 2.3 trillion has gone in. But when you do have these financial market vulnerabilities, they do tend to play out in the newer products.
So there's one question on here I'm going to turn to first before I go to the audience, and that is that there's been a sudden increase in support, according to the Chicago Council's polling, that 55%, up 20% from 20 points from last summer of we survey a wide range of people, now support free trade. So what are your thoughts on that?
I think sometimes that, we trade economists, we're often dining out on stories of, remember Smoot-Hawley, remember how bad it was under Smoot-Hawley. And fewer people actually remembered Smoot-Hawley. And this started sounding kind of, musty and old and stale. So we've refreshed a little bit on, what can happen when you do some of these things. And that's, how do you learn not to touch a hot stove? You can, listen, or you can just get a little sizzle on your fingers.
But I think it's showing the reality of the front loading we're seeing. Like, do I go out and buy a car now because it's going to be more expensive in a few months? I was talking to a colleague and they said, oh, my granddaughter is expecting her second child. And they told her to buy the double stroller now because in May they're going to make it 30% higher. So I think one of the reasons why you've seen this 20 percentage point move is there's now this realization that it's not that, the U.S. was losing out from free trade, it's that the cost for me is going to go up. And the work that we've done and that many of the independent think tanks have done do point to that this costs, the average U.S. household, if the tariffs that remain in place at the levels that we've talked about, $3,000 to $4,000 a year.
It's a lot. And just so for those of you who don't know Smoot-Hawley, because I remember it from an election back in 1992, but Smoot-Hawley, 1930, about 8 months into the Great Depression, give or take, they invoked tariffs on 20,000 different goods against 25 countries. We got into a trade war with 10 of those countries. Global trade fell by 67%, and it helped to sow the seeds for World War II, as well as plunging the global economy deeper into the Great Depression. Now, that point in time was when, a large tax hike in the middle of the Great Depression, in the beginning of the Great Depression, actually was deflationary. And so that's, those of us who are economists, that's the most cautionary tale out there.
And that was the motivation for a lot of the institutions that we've seen, is that you had people in the aftermath of the war say, we really shouldn't do that again. What can we set up so that we don't have to go through that pain?
Exactly. So we've only got a few more minutes left, and I want to ask people who are going to ask questions to be really, really concise in your questions, because we have such depth of knowledge between these two. So very quickly, what is your question, sir?
The dollar as a reserve currency, international reserve currency, it used to be like 2010, it was 70% of the reserve around the world was in dollar. Now it's probably around 50%. So it's the trend. You can see that's like a longer term trend. Do you see it as even continue to lower, given the self-inflicted, as you said, turmoil that we had in April? It's probably continue for a while. Would that accelerate the diminishing status of dollar as a reserve currency?
Well, I think that the questions about the dollar are going to remain, but there are not that many alternatives that you can really turn to that quickly. And one thing is that the overall reserves have gone down, that countries are holding, and the dollar share has gone down. But actually, dollar holdings in other securities, like in U.S. equities and holding U.S. fixed income, had gone up a lot. So part of it is there genuinely is a lack of alternatives that seem as viable given what the dollar dominance is right now. But certainly the nature of the questions, in my view, have changed. And you can see with the market volatility as well that this is changing. So I would watch very carefully what does happen with a lot of the Treasury auctions that are coming up, because by February of 2026, we really think they will need to raise the coupon and the size of the auction. And then you have to see how demand is being taken up. But I think you can also see in foreign holdings of U.S. equities were very, very high. And you've seen some deleveraging of that. We're still not long, though.
Yeah.
Which is why, I am not of the view that you've necessarily seen the worst for the S&P 500 at this stage. But I think you're right. The trend line of just dollar holdings of reserves has been steadily going down, as has the overall level of reserves. So that's one indicator. But there are a number of others that the composite is very much the trend that you're talking about.
Next one.
Hi, I was wondering if you guys could elaborate to the extent to which this economic policy factors into or is somewhat representative of Trump's general foreign policy, i.e., like the shifts to Russia and seemingly being more combative towards the European Union, and what I would argue is more of an isolationist foreign policy.
I think that is a debate on, are we actually moving to spheres of influence? And it raises the question as well, like, who are we defining as our allies if we're really focused on more bilateral relationships? And I think it's a work in progress. It's actually quite difficult to say that we know exactly what the end game is going to be for this. But I am more skeptical of some of the theories we hear about, like reverse Nixon, theory that they're getting closer to Russia just to sort of get back at China. I'm not really seeing that that's probably what is playing out. But I do think the U.S. China strategic competition being one that is, sort of at the heart of all of this is really the key thing that's going to drive the direction of where we're going to head in next with the geopolitical, relationships. But I think it's hard to define exactly what the foreign policy is right now because it's so transactional.
I don't know if you can answer this or not, Phil, but it brings up another question when you mention that is China is saying, listen, don't cut too many deals that cut us out of the equation. And this is an old one, the Trans-Pacific Trade Pact, which never got to fruition, but that would have isolated China in many ways, especially on intellectual property issues.
And that's what they're saying is, like, each side is using the word existential, right? Europe is saying the relationships with Russia and the direct dialogue with Putin is existential. China is saying, look, it's one thing to have a U.S.-China conflict, but if you're telling us we can't trade with certain countries, China, then that's existential for us. So I think it's hard to actually define where this is going to end up as an end game, but it's certainly very different than sort of the multilateral cooperation and the institutions that had been created that so many people had worked on over the decades.
And I'll just say, it's an example of what I was talking about with where there's spillovers, where these things move from sort of very limited, important but limited disagreements to something that's sort of more systemic and draws in others.
Right. And some are winners and some are not. So,
is there a danger that the tariff war could cause an increase in interest rates? The Fed might be forced to raise interest rates by the attempt to devalue the dollar.
I don't think I'll just take it just because I work on the Fed a lot. I don't think they devalue the dollar. They wouldn't want to devalue the dollar because, but could there be a situation where the Fed had to raise interest rates instead of lower it? They don't want to get there. They think we're in restrictive policy territory, and they also believe that the bond market is now in a place that it can do some heavy lifting for the Federal Reserve by keeping interest rates higher and interest rates more restrictive. We see it in the spreads, the credit spreads. I'm sure you could go into that, Joyce, that credit conditions are tighter. And that in and of itself could be enough to erode inflation along with the demand effects. Could you come up with a scenario that the Fed had to raise rates? If push came to shove, you could. I think Jay Powell's been very clear in his view that he's, even though he'd like to achieve a soft landing. I remember being in Jackson Hole when he made what was the "There Will Be Pain" speech, 8 minutes, 34 seconds, and it was like a bucket of ice being poured on your head. And that was that he was willing to take a recession if he had to. Now, luckily, we didn't have to do that. A big part of the soft landing story was the labor market stabilized and equalized because we had a huge influx of immigration. We can now have a debate about immigration, but that was a big role in the soft landing scenario. For the Fed today, Jay Powell has been very clear. He was just here at the Economic Club, and we're going to hear him on Wednesday. And he was very clear that if push comes to shove, he would hold off on cutting rates, even if the economy was weakening a lot, in order to ensure, until we knew for sure that inflation was coming back down again. And that's why we have our rate cuts a little later in the year than you do. But it is a risk. It's not in any of our scenarios right now, but it is a risk. Next.
Hey, good evening. I'm
And
Eduardo.
this
I'm a
is probably going to
student.
be the last
Sorry?
question because
Okay.
we're almost up to time. Sorry about that.
Of course. I'm a student at the University of Chicago, and I've had the opportunity to talk to former cabinet secretaries from prior administrations, and from both sides of the aisle, they agree that there's been an unfair trade coming from China, and China's been breaking WTO rules for years and years now, with heavily subsidized steel and so on. So my question is, now that we're seeing the tariffs don't actually have the effect people were thinking they were going to have, at least Trump was thinking that they're going to have, how do you believe that the U.S. as a whole could push back on China and make them play by the rules again and kind of even the playing field on trade and manufacturing?
Well, I think first of all that you really then have to look at which tariffs are strategic.
Yeah.
Right. And like children's shoes, bicycles, plastic Christmas trees, small businesses being affected by this. I mean, that to me is not strategic. But I think that just sort of you also have to look at that. For the U.S. dependency, I mean, it's not about reciprocity. I mean, the U.S. has quite a lot of dependency on China's imports, where it has a significant cost advantage. So we estimate that the cost advantage that China gives versus the rest of the world on imports to the U.S., I mean, for about 21% of it, it's more than 50%. Another, 50%, it's somewhere between 0 to 50%. So there's kind of two sides to that as well. But the U.S., I think, had been trying to address the overcapacity issue, which was not just a problem for the U.S., but also a problem for Europe. But
Yes.
that is, you need institutions that work, that enforce, right? That's the first thing, like not having institutions enforce. You need to be strategic. So not everything should be treated equally for what we import, because there are certain cost advantages that the U.S. also achieves. And you also need multilateral action as well. And all of those are things where that even if you agree with the sort of problem analysis, the solutions are not necessarily going to get you to, I think, addressing some of those issues.
Let me add, I agree with that. And let me add one sort of generic point. There's a misperception sometimes that the WTO, carved into marble, thou shalt not have tariffs, thou shalt not have subsidies. And therefore, anybody who had a tariff or a subsidy was clearly breaking the rules. That was not what the WTO said. That's not how the WTO worked. It was that countries would get together and say, well, we're willing to put limits on these tariffs, but not on these other ones. And we're willing to put limits on some of these subsidies, but man, I really like having this subsidy, so I'm going to keep that. And so usually the answer to, hey, wait, there's still some policies out there I don't like, was, okay, that's the fodder for the next round.
Right.
Let's get together, let's negotiate these things, and let's go farther. Note, by the way, that a lot of countries have subsidies that they like. Like, I don't know if you
Especially
have, for
in
example,
agriculture.
in agriculture. What if you have, say, an auto industry that's gotten in trouble and you want to provide some support to an auto industry that's had trouble? So the question is, one shouldn't just sort of take it for granted that just because you saw certain behaviors that they were automatically cheating. They may have been. I'm not taking a stand either way. But the sort of tried and true approach was, let's tighten up those rules and then let's make sure we have a system of enforcement that works well.
Well, that's sort of the moral of the story here, is that I think all of us agree on one thing. And clearly, I think China has sort of played a role like Japan did back in the 1980s, although it's been more of a 2-decade-long issue. Mm-hmm. But rules of engagement, if we all know what the guardrails are, we can stay within them. But over the years, we've seen a deterioration in those guardrails globally. And now, in the lack of trust, there is this move towards bilateralism, which is not the place where we see the solutions, but it is understandable in many ways that we're in the political situation we are. With that, I'm going to leave you with one last thing, and thanking our incredible guests. But I'll leave you with one last thought, and that's one that I spend a lot of time thinking about, and that is that what binds us is greater than that which separates us. And I see a friend in the front row that I broke bread with last night. I believe in breaking bread instead of breaking ties. And I hope we can have some of our friends in the global economy not be so afraid of us, but be willing to negotiate with us. Thank you, and please thank our incredible panelists.
Thank you, Diane.